In this video, I'm going to be sharing what's happening with interest rates, inflation, the global markets, and what you should probably be considering doing about it early this year in 2022. Let's get into it. This is usually where someone on YouTube says, I'm not a financial advisor, but I actually am a registered financial advisor in Australia to provide personal advice. This video though is only general in nature, which means that it's not specifically tailored for you and you shouldn't take anything I say directly and take action from it. If you want to take action, reach out to us, get some input, reach out to a financial advisor you already know, or take stock of the fact that this is your personal decision. Here's to making great decisions. Hey there, Tristan from Purpose Advisory. I hope you've had a great start to 2022 and are looking forward to a fantastic year ahead. I want to distill for you some of the most important ideas that are taking place in macroeconomics, these forces that are influencing the stock market, the property market, the crypto markets, and everything else in between. A lot of the time, you can afford to ignore a lot of what economists say and what's going on in the economy because it's largely just noise. It's a distraction from the timeless principles that serve simple investors over the long haul. Simple principles like diversify, invest for the long term, regularly buy in at intervals across the way, have cash on hand for opportunities, stay invested, don't buy and sell too often. These are the sort of things that lead to success. However, there are certain times in the economic cycle where it pays to spend a bit more time educating yourself and understanding what's going on. And we at Purpose Advisory believe that now, early in 2022, is a good time to be paying attention. So without further ado, I want to get into what you need to know about inflation, interest rates, and the year ahead. So first up, it's important to understand what is inflation in the first place. And all of us have an intuitive sense that prices go up, and inflation is largely the increase in price over time of items. From coffee through to soft serve cones, through to your daily appliances and technology. Almost everything you'll see year on year will increase. Items that you might have noticed drop over a period of time will typically pick up in the long haul. And when you're measuring inflation, you typically do it through a complex formula, but in this case, looking at the price it is today, dividing it by the price it was in the past, putting it to a factor of the time frame, in this case, 50 years, 49 years, and then producing a percentage. So importantly, 3.85% per annum is the average inflation of this cup of coffee in US dollars over the past 50 odd years. So we measure inflation as a percentage per annum. And that percentage is really important, as we're going to see in a moment. Now, you might think, what are the items that don't inflate? Is there anything that goes down in value over time? And if you stop and have a think, you'll probably struggle to come up with even just one item. Why is that? What's really going on here? Well, the fact of the matter is there's two warring forces. These forces act both to support us and also to put pressure on us. The supportive forces are ultimately the forces of productivity growth. They're like wind behind our sail. As a holder of assets, of cash, they're making things more affordable all the time. This is Moore's law, which simply put is a very well tried and tested theory that digital technology tends to double in effectiveness every 2 years. It's pretty incredible, but that's what's happening. This is the various microchips that are being produced over time, which are effectively double as useful and effective every 2 years. This is a logarithmic chart. And that same theory holds for a lot of technology. That's putting pressure on prices to go down, down, down. However, even with this wind behind us, as we're running on the treadmill of life, there seems to be this force that we have to struggle and contend with all the time, even just to keep our money to hold even, let alone to move forward in the rat race of life that you often feel in financial markets. And this force is money inflation. Whereas growth and productivity is a natural aspect of human function and behavior, money inflation is a contrived or unnatural force that we've built into our economic system. Our government structures have baked in money inflation. What does that mean? There's more and more money all the time, which is making prices ultimately go up, and thus our wealth go down, which comes to the point of what is the impact of inflation? Well, inflation ultimately is erosion. Your wealth today will be worth less and less over time. And I picked this image because it's pretty drastic. You don't want that sort of inflation or erosion to be impacting your wealth because it's going to lead to risks and harm. In the words of Milton Friedman, a very well-known economist over the past couple of centuries, inflation is taxation without legislation. In other words, if you hold cash today and still have cash tomorrow, you've been taxed by the amount of wealth that's eroded from your hands. Very interesting idea. Now, this is even compounded further by the fact that we don't understand inflation. Our minds just can't get on track with this idea of our cash going down in value every year, because we look at the dollar figure, we look at our bank balance, and it still says $1,000. It said $1,000 last year, it says $1,000 this year, but we don't think, hang on, that $1,000 is worth less than it used to be. If you look at this really cool visual, some of you might have seen it before, it looks like these lines are slanted, but they're not. Each of these are parallel to each other. There's no slant going on. It's an illusion. It's optical illusion, and that's really what inflation is. It's an optical illusion. If we had a theoretical inflation rate of 3.5%, then what it says is any investment that you take, if it produces more than 3.5%, then it's actually making you a profit in real terms. However, if it's making less than 3.5%, you're making a loss. Even 3% is still effectively negative 0.5%. And to break it down a little bit further, here are some examples. So at 0% inflation, you have a 5% investment producing 5% profit, no influence whatsoever. However, as soon as inflation creeps up to 2%, which is what Australia intends as its target inflation rate, 5% is only really worth 3 now. The hurdle's harder to get over. At 6% inflation, a 5% performance is actually still making you a loss because the hurdle is so high. As a result, this line becomes your new zero. You need to start reorienting your mind to a 5%, 10%, 20% performance. It's not as it says. You need to factor in inflation. So what's really going on? What's the current state of play? First, a little bit of backdrop. The government is largely the force that controls and influences inflation. They do it through various vehicles. There's the central bank, and there's also the executive and the branches. So there's 3 goals that the government has in how it carries out economic policy. Number 1, keep everyone employed. Make sure everyone's able to earn an income because that keeps stability. Typically, that's seen as priority number 1. Priority number 2 then would be to keep stable price growth. They want prices to go up, but they don't want it to go too high. You know what happened in Zimbabwe, in Venezuela. People were wheelbarrowing in their cash to get some bread, and by the time they got to the bakery shop, the price of bread had gone up 5 times and they can't even afford it. We don't want that to happen. We want it to be stable. However, there's this third sort of unspoken objective that all governments seem to have adopted, especially in the Western world, and that's to keep the market growing. Some people would even say that this is usurped employment, and now governments primarily serve markets, trying to keep markets moving. Now, I wouldn't agree with that. I would say that employment still takes sort of top dog, but once employment's ticked off as solid, governments focus a lot on keeping the market growing, which is largely why we're seeing more inflation these days. How do they do it? What are their tools? So they've got 2 levers that they can use at any point in time. First lever is they can change the interest rates. So the government will set the base interest rate, and then every other interest rate in the economy, including your home loan rate, your car loan rate, and then maybe a credit card rate, they're all derivatives or extensions of the rate that they set. As they change that one rate, the other rates will move typically in line with them. If they increase the interest rate, it's harder to borrow. It's kind of like a handbrake on the economy, and you'll see the stock market pull back. You'll see everything start to wind down a little bit. On the flip side, if they pull interest rates down, then borrowing becomes much easier. It's not as attractive to invest in safe assets. You want to take more risk, and the market tends to speed up and you see more inflation. So that's interest rates. On the flip side, governments can also print money. They can just flood the economy with more currency. If they're to increase the amount of money supply, then prices are naturally going to go up because just more of everything to go around, so you can buy less with what you had previously. At the same token, if they're to reduce the money supply, they can reduce prices. Doesn't happen very often. But these are the 2 levers that the governments use, and they can use them both at the same time to pump things forward, or they can pull things back at the same time to really put the brakes on. So what are they doing at the moment? If we look over the past sort of 25 years of what's been going on, this is Australia and this is the US, you'll see that there's a common trend. Interest rates have been decreasing. There's been some ups and downs, things going on, but effectively we're now near zero in both cases. So we're definitely pulling things back, i.e. pumping up the economy. And then what about the money supply? Well, these charts are pretty ludicrous. This is M1 is the one base measurement of the supply of money. There are others like M2 and M3. But if you just look at the MY supply graphs, which is probably the most interesting, you see these massive jumps, especially recently around COVID. This one's just astronomical. It makes the rest of the line a bit of a farce. You have this gigantic leap up, and then not just is it super high, but then you have this increase in the slope. It was sloping quite narrow, and now it's sloping quite steep. In other words, that again, you're increasing money supply, you're going to be creating more growth, more inflation. What's been the consequence of these longer term policies? Well, this is in the mid to near term. You have this amazing property growth in Australia and in the US. And then you have this amazing stock market growth as well. Interesting to contrast between the two. The US has had much more of, I'd say, an artificial linear growth curve. We're supposed to see undulations, ups and downs. Everything on Earth seems to work with waves, the natural world at least. What you're seeing here is a straight line. And here you're seeing a straight line, a bit of a blip, and then another straight line, a steeper straight line. And you could probably correlate that to this weird environment and this crazy spike. In other words, what you're seeing in these markets, particularly the US market, is a highly manipulated market. Like it or hate it, if you've been invested, you've been benefiting from all these growth. If you've got a property, if you've got investment property, a lot of this growth is largely due to the government policies that have been taken. However, there's a consequence. So market's doing great, but what about those other two mandates? So unemployment, look, it's been hovering on the higher side in Australia, and we've managed to get it actually down into the target range after this spike during COVID. Admittedly, a lot of the employment that we're talking about is really JobKeeper, but now that that's sort of dried up and people are getting back to jobs, you can see that the employment rate's actually really improving. So that's a great sign. Similar in the US, they were actually able to hold their target rate for quite a while until COVID came. And then you can see they're really focused on it. They pulled it right in. This is a high priority item. They want to keep people employed. Now, you can argue whether it's full employment or adequate employment or whether they're getting paid enough. That's a separate question. They just want to look at how many people are employed. That's their measure, But this other thing, inflation, look at this. Now, in Australia, you can see there's been this minor growth and then this boom to 3.8%, and it's been hanging around there. And this is the most recent data, and it hasn't resolved yet. We don't know if it's on its way down or if it's still coming up. In the US, there's monthly data, so you get to see a bit of the progress. And as you can see, it pulled back a little bit here, but it's only grown since. And most recently, it's now at 7%. Remember, we talked about inflation is your new zero. In other words, if in the US, you're not growing by more than 7% per annum, you're actually going backwards in real terms. That's the tax that we're talking about. That's the erosion of your wealth. What a crazy environment we're in. Now, what does that mean? There's a lot of things that it means, but first up, it should shock you to realize I cannot just let my money sit in cash and do nothing. We have to start being more smart, have to be more mindful of the cost of keeping these in cash. We're not going to jump into markets straight away. It's not as simple as that, but we have to be mindful and vigilant, right? So this is, I guess, the mandate of what's been going on. With these sorts of numbers, everything else is under control. The government's going to have to start doing something about it, right? And if you think about who's in power in the US at the moment, we've got the Biden administration, that's the Democrats. Who's the main voting base of Democrats? They're going to be the lower socioeconomic, they're going to be the more marginalized groups, the people who typically have less strong wages that don't keep the pace of inflation. So as the price of everything's going up, wages might be only going like this, and these people are more price sensitive. So what are they feeling right now? They're in pain. The gas bills have just doubled. Their housing bills and grocery bills are gone up 40, 50%. Maybe the rent's increasing as well, and they don't have more income to see. They might have been on the poverty line. They might have been barely breaking even. They might still be in debt. These people are yelling out, hey, we need help. And so the government's thinking, all right, got to do something. This is a midterm election year. There's a lot of impetus to shift gear. So that's what we're seeing. Both the US and Australia and a lot of these governments around the world are now starting to go, we got to do something about this inflation thing. So inflation has now led eventually to a shift in policy. And what's curious is if we go back to what's been happening, you can see that interest rates are still low. They haven't actually increased them, not in Australia, not in the US. And the money supply, it hasn't really slowed up. Like this is live data as of this week. So we haven't actually seen a change in the decisions that are being made by governments. They're still doing the same thing. But around November last year, the US Federal Reserve, that's the central bank, started to change their tune. They started saying things like, we're going to have to look at this. Maybe this inflation thing's a bit of a deal. Maybe we need to start increasing rates. And just the indication that they might act has already led to a really strong sell-off. This is like 10 to 15% correction, which is a significant correction. We had a lot of growth in the past few years, so it feels like a little bit water off a duck's back. But still, 10% on the stock market is a crazy big correction. It typically happens once every 2 years, and it's there to keep things balancing out. We've had similar correction already in the Australian market, and I suspect there's more to come. I think we haven't even really seen the full weight of this. I know that people have now consumed and started chewing on the fact that there's going to be increased rates, but we haven't seen them happen yet. We haven't even seen the impact of them just yet, and that's probably going to happen from March onwards in 2022. So it's important that I've got to reel this thing in. But if we look at how much they can do the reeling in, there's two things they can do, right? They can increase their interest rates and they can cut off the spend. If we look at interest rates, there's an interesting narrative here. I know this is a busy chart, but in green you have the stock market. This is a logarithmic chart, so you can see the stock prices on the side, and the blue line is the interest rates. And what happened here was, this was the dot-com crisis. All these tech stocks back in the early 2000s were just going off the chain. Everyone was buying them just because they look cool. And they reached a peak where it was just way too hot. In the lead up to that, the government was like, whoa, this is really overheating. We got to cool it off. So they started to reduce the rates. They started to increase the rates to make it harder to invest. And it had the right effect. The market did cool off, and it was a significant pullback. It was like 50% drop at least. Some of the tech stocks like Amazon dropped 95%. Most of the tech stocks just disappeared. They went 100% down and went to zero, and you never saw them again. Once that drop started to happen, the government's like, oh, we might have overcorrected. All right, let's pull the rates right back, because they didn't want a recession. They had to pull it all the way back here, got rates eventually down to 1%. And by that point, the market has sort of found its feet and it started to pick up again. By this point, we were now thinking, oh, we've probably stimulated a bit too much. Let's pull them back up. So they increased rates pretty gradually up to this sort of 5.5%. Some of you might remember when home loans was 6, 7, 8%, just before the GFC. And then you had a similar thing go on. You had all these concerns, things were starting to unravel. This was where you had the no income, no job loans. People put zero money down, bought a house just because the market was going up. It was just crazy. It's crazy times. Then you had the huge stock market collapse. And during this time, the government realized, look, we probably pushed it a little bit too hard again. We're going to pull back. And what's interesting with what the government's doing here, I would say it's a bit akin to going to the supermarket with your kid, and the child wants the chocolate on the shelf, and they start yelling for it, and you say, no, I'm not going to do that. I'm going to raise rates. I'm going to be a bit firm with you here. And then they hop on the floor and they're beating their fists in the ground like, no, I want. And you're thinking, oh no, I don't like this moment. I can't deal with this. This is just too much. And so what do? You take the chocolate off the shelf, you unwrap it for them, and you stick it in their mouth. And not just there, but rates go right down to zero pretty much, right? It's like, here's 5 more chocolates here, and you have like, please calm down. I don't want you to yell, don't cry. It's like, just appease the market. We don't want to see the whole thing fall through the floor. Now, I can't be too critical on the US government, let alone like all governments, because it makes sense why they do it. Like, no one wants a recession. No one wants to have blood in the streets. No one wants to have companies, big banks fail, millions and billions of dollars wiped off people's balance sheets. It's not good, especially not good for the wealthy people who have the largest say in government. It's not good for almost anyone, really. So it makes sense why they supported the markets. But what happened was they kept rates down here. And once you got into this zone of like 6, 7 years where rates were really low, at the same time they were printing money, you had this great growth. Ever since then, if you'd have bought into the market here, wow, what an amazing run. You've had things on this scale sitting at sort of 80 right up to 400. So it's more than 5.5 times multiplier on your investment over a decade. Whoa, what a crazy growth. But you're now looking at a different analogy. This isn't just a kid in a candy store. This is a bit more like a junkie on a drug. We're addicted to this thing. It's a bubble, yeah, but it's not one particular thing. It's the bubble. It's like the whole market, the whole economy has been pumped up through this very unnaturally low set of interest rates. And the government did try to increase rates here, But what happened here was GDP, so growth of the market slowed, and they're like, oh, we don't want this. So they cut the rates right back down. And if you look at these three increases, you'll notice the pattern, right? They're getting lower every time. In other words, markets are becoming more sensitive and governments have less influence, less leeway. Or not less influence, rather, it's just that their decisions have a greater implication. So it's kind of like when you're steering and you kind of oversteer and oversteer, it's really hard to be able to do those narrow steers. And it means they have very little that they can do before the market starts panicking. It's a very interesting state to be in. And I would say that this cycle still has a little bit more to it. You could say that this is doomed to fail in the next couple of years. The whole thing's going to unravel. I don't think so. I have a view that in the next sort of 3 to 10 years, we're going to see much more unraveling, but not straight away. I think there's still more legs for the current economic makeup to continue running as it is, but that's just my opinion. Importantly, what might happen? Well, the truth is we don't know. There's no crystal ball. It could go various ways. It's largely influenced by what government does, but they're not in full control either. So let's go. There's two cases. There's the bull case. That's kind of like the good case if you're an investor, and then the bear case, the bad case if you've got money in the market. Depends how you look at it, really. But in the bullish case, probably a modest correction in the short term with more growth to come, and get back onto the horse. And in the bearish case, probably a larger correction with some stagnation. So let's talk through it. Governments stop printing money and start increasing rates like they said they'd do. Major markets correct. We've already done 10%, maybe up to 25% in the course of just a few months. Inflation starts to drop back as we were hoping to, as it needs to. It probably won't get to its target. It won't get to the 2% it needs to for various reasons. Supply chain issues, all the money's been pumped into the market, inability to be able to tolerate higher rates. So, going to have to get used to these sort of slightly higher inflation numbers. Unemployment will likely begin to rise, fueled by the sharp correction. Governments will then likely come in as the white knight to flip-flop and save the markets. Like, cool, we're reducing rates, we're going to pump the money again, everything's going to be good. And then the market should get back on with its merry way. And a lot of investors are hoping for that. They're willing to have a little bit of pain, but they're hoping that the market will kind of zoom up from there. In an alternate scenario, though, you might see that governments stop printing, start increasing rates, but it doesn't work as well as they thought. You might get a really strong correction in the markets. Everyone freaks out. There's more fear and panic in people's responses. And inflation might not decrease. You might find that the US inflation drops from 7 to 5 to 4.5 and then hovers there. And what do they do now? They've already hamstrung the economy, but they haven't got inflation in check. Unemployment is going to stagnate, maybe bearable levels, but rates are going to have to stay high. They're just going to have to ride that out on a higher time period, cause more pain, but ultimately try and reel in that inflation. And you might find that there's at least 12 months where the market dips and doesn't even come back to where it is. It could take a number of years. If it's a significant correction, it could even take 3 to 5 years to come back to where it was. It's not unrealistic. My opinion is that we're likely to see the bullish case in line with what I said before. I think that everyone intends to kick the can down the road and keep things running. It's not fully in their control, so there's a risk that it all falls apart. But I think most people's incentive is to keep the story going. And at the moment, it's not too far out of control. But the key, I guess, whichever scenario plays out, would be stay vigilant. Look for opportunity. In both cases, there's a correction coming. I'm pretty confident about that. We're already seeing it, to be honest. It's not like I'm calling anything, really. However, there will be great buying opportunities for property, for individual stocks, for indexes, you name it. There'll be much better prices now than there has been in the past 6 to 12 months, where markets have been very highly priced. So, how should you respond? What should you be doing? These are, I guess, 5 really simple principles or key takeouts. Number 1 is that get used to higher than usual inflation. When you're budgeting, expect things will keep going up, and you've got to accommodate that. 2, recognize that government decisions are leading the way on the way the market works. So pay attention to some extent of what they're doing. That will lead what markets do. Markets listen to government very acutely at the moment and will respond to it. Prepare for money printing to continue. Rates will stay low. Even if they pick up, I don't think they can stay up for long. I think they're going to come back down most likely. So if you have a home loan, get comfortable with a little bit of a higher rate, but bear in mind that it's unlikely we can sustain higher rates for the longer term. Prepare for your cash to erode away if it's just sitting in cash. and then prepare for scarce and valuable and productive assets to be the ones that really grow. Even if they do correct in the short term, these are the things that we want to be acquiring for the long haul. What are they? Gold, stable property, crypto assets, quality tech stocks, quality large cap companies, FANG being the commonly referred to top dogs of the market. You want things that 10 years from now are going to have been great investments. Last thing I want to share with you is probably 10 things to focus on, things to do. There were 5 things to be mindful of. These are things that you should be doing. So upskill and get smart about maximizing your income and employability. In an environment where we might see unemployment start to pick up, where inflation's a thing and markets are pulling down, if we get a recession, you want to be the most employable person in your role. If you're self-employed, you want to make sure your clients don't drop you. So key. Make sure your income is increasing year on year. It's the best thing you can do for your wealth creation. Number 2, make sure you got emergency funds. Don't get stuck with your pants down without the cash, especially if you get in a pickle financially. Number 3, find smart places to leave that cash. Whether it happens to be an offset account, so it's at least getting better than the zero rate, or you can find some clever liquid assets. Be mindful that you don't want to leave too much in cash if you don't have to. Point number 4 would be have liquid funds available. Like I said, look for opportunities and know that you've got a bit of a wardrobe ready to jump on a great opportunity when it comes. Warren Buffett, one of the most successful investors of our time, has been gradually increasing his cash reserves over the past few years, and he's still waiting. He's waiting for the opportunity to come. He might be waiting for another couple of years, but it could be this year, it could be later. Acquire long-term growth assets and dollar cost average. Don't put them all in at one point. Average out your risk by buying a bit here, a bit there, a bit there. Expect to hold those assets for the longer term. Look, this is not a good time to be investing short term. This is the worst year, I would say, to look for short-term gains. Picking the bottom, if we do have a bottom, is going to be exceptionally difficult. If you choose to pick the bottom, you're going to get stuff on your hands, right? Limit and manage your debt or leverage. Even though rates are very affordable, they will be increasing, and we might see a bit of an unraveling. It's a dangerous time to be taking on undue debt. This is a good time to be taking stock of your debt levels and making sure they're managed, Have at least one hands-on strategy. So relying on markets is great when markets are going strong, but when markets fall apart and there's a recession, having the ability to build a business, a trading strategy, a property development strategy, something where you can manufacture value through your skill and your interest, it's going to be invaluable. It's definitely something to do alongside maximizing your income. And then finally, take the time to learn how to invest. Learn these basic principles we've been discussing. It doesn't take too long, and it will definitely serve you, not just with your wealth, but it'll serve you in the way you see the world. It improves your perception of how incentives influence people's behavior. And I'm a big believer that becoming a great investor definitely helps you to become a better parent in a number of ways. So look, they're my key takeouts from what's going on at the moment. Hopefully that was practical. If you have questions, if you have comments, if you need to have a sit down and have a conversation, please reach out to us. We'd love to offer our assistance. We're financial advisors, we're coaches, we're life coaches. We're here to help. Looking forward to having a greater conversation in depth in person. All the best. Ciao.